From a tax planning perspective, what's the biggest mistake families make when they inherit a large traditional IRA today?
Well, I think the biggest mistake is just to not have a plan. So, what the opening references is a law change. It used to be that you could leave traditional IRAs, traditional 401ks to loved ones, and they would take a so called required minimum distribution based off a table based off their own age. So if you left it to the 10-year-old, they could stretch that IRA. People used to, I think Ed Slott may have coined the term the stretch IRA. I'm not exactly sure who coined it, but the idea was, well, you would take it over this IRS lifetime distribution payout, and you could take a very small amount every year, and the account would keep growing tax deferred for the rest of the beneficiary's life. In 2019, the Congress basically saw that and said, wait a minute, what are these retirement accounts really for? They're really for the owner and their spouse to get to and through retirement with financial success. So they said, what we're going to do is we're going to increase the tax on the beneficiary, the second generation. They actually cut the tax on the first generation by delaying RMDs. So now most adult children, so think about who typically inherits our retirement accounts. Spouse is the preferred beneficiary for a number of reasons, including in the tax code. The change we're talking about today mostly does not impact the spouse. But eventually you get to the next generation. That could be children, grandchildren, nieces, nephews. Those type of adult beneficiaries now have to take those traditional retirement accounts. Generally speaking, I'm assuming no disability or anything like that. Generally, they got to take it over 10 years. And so now what you've done is you've compressed income because you have an IRA that somebody worked for a lifetime that they were going to live off, for 20, 30, 40 years in retirement. All that wealth has to become income within 10 years. And I think people worry about that. I don't think it's something to be all that worried about, but I do think it's something you got to have a plan for. And I think that's the mistake folks make is they don't have a plan. And to be fair, none of us went to school to figure out how to inherit an IRA. Inheriting an IRA of any size is a big signal that now might be the time to put a plan in place. And that might be with a professional. And that, we could talk about that more later. That's, I think, the big mistake folks make.
Thank you for the foundation. Denise, what's the biggest misconception you still hear about the Secure Act's 10-year rule?
Well, that there is no annual required minimum distributions. When Secure Act was just signed into law, the language was very confusing. And almost everyone that you knew, me, Sean, call you Sean, all the experts on the street read the tax law to say, if you're subject to the 10-year rule, you don't have to take annual required minimum distribution. And then when the IRS published the proposed regulations, they said, listen, Denise, you and your friends, you're forgetting about the at least as rapidly rule. What is that rule? It means that if the IRA owner had already started taking annual required minimum distributions, whoever or whatever inherits that account, they must continue at a rate that is at least as rapidly at the rate that the owner was taking it. So if you inherit an IRA, you got to ask yourself, did the owner die before the required beginning date or not? Because that's one of the questions, the answer to one of the questions that's going to drive your distribution options.
Yeah, that's an important one. Knowing if you have to continue taking the required minimum distributions. Otherwise, it sounds like you do have some flexibility, which goes back to what Sean was saying, the need for planning. Roger, how do you help clients shift from thinking about preserve the account to using the account strategically?
And I want to just point out what Sean said in that, and what Denise emphasized was this stuff is complicated for us, and we think about this stuff all day long. And the IRS comes out with rules that aren't fully thought out or communicated. So I can imagine for anybody trying to think through this stuff, it's confusing because it is for us as well. I think it is a little bit of bittersweet, and I like that kind of framing of things. Yes, it's bitter that, taxes on IRA distributions from inherited IRAs haven't increased. That's not true. They've just been, the taxable income realization has been compressed, and that's bitter because everybody wants the deal. But there's a lot of sweet that came with this rule as well. And I think Sean pointed this out, in that this money was not meant for inheritors to be able to stretch out in some major way. It was meant to fund people's retirements. That's why the government blessed us with tax deferral in the first place. And so the sweet part of this is, although it creates some different problems, it actually forces some simplicity, because now we have a 10-year window to get this done and figured out. So we don't have to manage something near as long. And that's a plus, because generally we like to overcomplicate things. And the second is, it forces the conversion of money to what money's purpose is, which is to use in your life in some way. So it forces us not to just simply think in financial terms. And I've experienced this in practice, of taking money out within 10 years. Yeah, that's annoying, but it does make it simpler, because we don't have to deal with this hanging chad of an inherited IRA for 20 years. And also it creates, what does that make possible, which generally is using that money, whether it's for gifting or go-go years or private school, whatever. I think there's a lot of positives to that as well, even though the tax bill is going to be there. It would have been there either way. It's just forcing it earlier. And one last thing I'll say, if I can, related to, the big mistakes that people make. Generally, they're the two extremes. It's either ignoring it and having unforced errors because you're thinking too little about it. And generally that's a mistake we make because this is so complicated. But I think on the other extreme, which is even just as dangerous, which is thinking too much about it and trying to over optimize this in some way that becomes, creates its own sense of unforced errors. I think the sweet spot is the middle, what Aristotle called the golden mean. We can think way too much about this stuff too.
So it sounds manageable.
Oh yeah.
If we don't pay attention to it, can it really cost a family 6 figures over time?
Tell me the size of the IRA that they're inheriting, right? It's every person's going to have their own, the severity is going to be different for each person on the size of the IRA, what their other income sources look like, et cetera. It's, we use this kind of math when we think of like lifetime costs for healthcare. Like we do the present value of what all the future costs might be to create this nice shocking number. And, where we come up with these phrases like tax bomb and stuff like that. That's just more inflammatory and clickbait than reality. I think it's going to be a case-by-case situation. I actually don't like that kind of language because I think it overemphasizes the financial part of it. When we're dealing with stuff like this, I always think of my favorite quote, one of them, by Thomas Sowell, is there are no solutions or only trade-offs. These are the rules. And the idea is just be intentional about how we think about the trade-offs, because we're not going to get out of them. There's always going to be a trade-off.
That is fair. Some of the clickbaity stuff, that's for YouTube. So just stating that there.
May I jump in here?
Please.
Because, I look at it from the other side. The Secure Act taking away the stretch is one of the worst things that they could have done to people who are not wealthy, because it takes away the opportunity for building wealth over a generation. Here you are telling people who have worked all their lives to save their retirement accounts. And I'll tell you about, from my perspective, the money in my tax deferred retirement account, many people will say, oh, it's for you, it's not your kids. It's for my kids, because we never had the opportunity to build generational wealth. And this is the first time for a lot of people. And now Congress has said to people, we don't care because it's not your retirement. Generational wealth, what? We don't care. I think it's one of the worst pieces of legislation that has ever been signed into law in recent times.
Sean, you have anything to add there?
Well, so, I think both Roger and Denise make very valid points. If I were inheriting a sizable IRA, if it's 10,000, okay, you got to deal with it, fine, but it's not really going to move the needle in your financial life. But say I inherited $1 million traditional IRA or $2 million traditional IRA, I would know, hey, this is something I got to think about, I got to plan for. And I would start with, what's the opportunity here, right? What are the things that we could do very well here? And I would argue that an inherited IRA can do three things very, very well. The first thing an inherited IRA does very well is hold bonds, right? We're not giving investment advice in this discussion, etc. But I think it's a fair assumption that many Americans inheriting IRAs are going to want to have some piece of their portfolio allocated to bonds. And so then they got to think about their own retirement account, their own Roth account, their own taxable account. Where do I hold those bonds? I would say the number one best place to hold a bond or a bond index fund or whatever it might be is a 10-year inherited IRA that's got to be drained in a taxable fashion. You keep that account lower, it doesn't grow like a weed, and you sort of manage for the growth issue, and you keep that interest income off the tax return. So that's good. Second thing an inherited IRA is really good at is paying income tax. And this is especially true if we're under age 59 and a half. So folks don't like to access IRAs and 401ks before 59 and a half because they say, unless I do some planning or meet an exception, I'm going to have a 10% early withdrawal penalty. So that's not a great place, generally speaking, to pay income tax, but not if it's an inherited IRA. You could be 1 year old, 100 years old. That 10% early withdrawal penalty does not apply to an inherited IRA. So if you're in your 50s, you inherit one of those things and you need to make some tax payments late in the year, you could do that. And oh, by the way, that's deemed to occur equally throughout the year. So you don't have to be as married to the quarterly payment system because you say, I've got this source that I can withhold from, pay federal income tax, state income tax, and even if it's late in the year, they say, well, it's deemed to occur equally throughout the year. So that's the second thing. And oh, by the way, that thing's got to get drained anyway. So, I mean, yeah, it creates taxable income, but that's going to be taxable income at some point anyway. And then you say, well, those two things, holding bonds, paying taxes, that's not fun and exciting. But the third one is early retirement. What happens is if you inherit $1 million traditional IRA, a $2 million traditional IRA, I'd say that's the time to reassess your own finances, reassess your portfolio allocation, and reassess maybe it's now time to step out a little earlier from my work. And maybe what you could do is live off that thing first. It's got to be drained over the 10 years. You live off that thing first before you access your own retirement accounts, your own taxable brokerage accounts. And it could be a way of facilitating. Sometimes I'm a football fan, so I refer to it as the bridge quarterback of the early retirement. Yeah, it's taxable, but you might be able to shield some of that with the standard deduction, get some of that in the 10 or 12% bracket. So the way I sort of look at these inherited retirement accounts is, one, they absolutely need planning and intention. But then two, let's start with the opportunities on the table. And I think paying taxes, holding bonds, and facilitating an early retirement are three potentially really good opportunities there.
Thank you for that. We're going to move to segment 2.